We have good news to share, we think, and that's the purpose of the question mark. So I welcome you and thank you for joining us. I'd like to begin July 24th. The market appreciated another 2 or 3% across the board. And then earlier this week, Fitch announced a rating downgrade on U.S. government debt from AAA to AA+, which has put downward pressure on the market, and it brings us back to just about where we were for July 24th. So let's look at these numbers. Year to date, the S&P 500 is up about 18%. It closed today at 4502. The Dow's up 6%. The NASDAQ is really the leader year to date. It's up over 30%. Today it closed at 13,960. And if you look at European stocks, developed market European stocks are up nearly 10%. And across the global economy for all risk assets, equities, that last index that we normally look at, the MSCI All Country World Index, you can see across the board that stocks are up 15% across global equities. One of the outliers, one of the surprises that we see is the Shanghai Composite. It's a measure of Chinese stocks, up just 2.5%. And really, the Chinese economy has had a tough time coming out of zero COVID. And even today, growth rates, GDP rates in China continue to be trimmed back. And there's a real concern about growth from China. That's reflected in their stock market. If we look at the S&P 500 and we spotlight that over the last 6 months, we go back to March if we go back to March, we can see that the index is up nearly 20%, just over 20% actually. And by any classic definition of a bull market, it is from trough to peak. Any increase of 20% or more marks a bull market. So whether you're subscribed to the market being in a bull or bear market, at least by definition, we're up 20%, which means that we're at the beginning of a bull market, and fingers crossed that that will continue. If we look at the components of the S&P 500, it begins to give us some insight into where the positive returns are coming from, what's driving the overall equity returns. You'll remember that last year, virtually all of the return was from the energy sector, and almost every other sector except for utilities was in negative ground. And we've seen a reversal in that and a much more broad-based participation in terms of what's driving the market up. The three leading sectors are consumer discretionary, information technology, and communication services. So when we look at, in particular, information or technology, it's up nearly 44% year to date. A lot of that has been driven by an excitement around AI. And we know AI both in terms of technology companies like Microsoft and Apple and others, but also in particular the chip makers that drive the computers that compute AI, artificial intelligence. For example, NVIDIA, one of the leading chip makers in the sector, is up 220% year to date. If we look at communication services, another important driver, this captures companies like Google and Meta. Meta's up 170% year to date. So it's been, these are the primary drivers of the S&P return. But if we look at just why the broad market indexes are up, there's really two components. One is earnings, and the other is a increase in the PE ratio. In other words, the price that investors are willing to pay for $1 of earnings. Now, earnings are up only 7% across the S&P, but as we saw before, the S&P is up nearly 18%. So the remainder of that has really been a PE appreciation. In other words, investors are willing to pay more money for $1 of earnings. So it's important to recognize that the PE ratio has been an important part of what's driven the market up year to date. And if we look at that in particular, as Chris had noted in his quarterly investor letter to each of you, that there's a few observations that we think are really important. On the left-hand side of the slide, we see the PE ratio, the price earnings ratio of the top 10 stocks in the S&P 500. You can see that that's where most of the appreciation is. It's been concentrated in these largest companies, Microsoft, Google, Amazon, Apple, and others. They are what are driving the market. So what that tells us is relative to the rest of the market, it really is concentrated in the top 10 stocks. So as we see such positive year-to-date returns, we can be reminded and our enthusiasm tempered a bit, knowing that most of the return is concentrated in a small number, the largest top 10 stocks in the S&P 500. On the right-hand side, there are two charts that Chris pointed out in his investor letter. The one in the upper right-hand corner shows the weight of the top 10 stocks of the S&P 500, and that represents nearly a third of the value. So the top 10 stocks represent a third of the value of the S&P 500 index and the return. But what is interesting is when you look at the lower right-hand corner of the graph, that those top 10 stocks, although they represent a third of the value, they only represent about 20% of the contribution, the earnings contribution. So there's a disconnect there, and it's driven by the PE ratios, it's driven by forward anticipation, but nonetheless, there's a disconnect there. And I think that it's worth analyzing and looking at that and being mindful that as we see such a strong equity market year to date, that there's some underlying weakness to it. It's concentrated in the top 10 stocks, and that there's a disconnect between those stocks and their earnings. But nonetheless, we're off to a great start in the year to date. Turning our attention a bit to interest rates for a moment. We watch really closely as a bellwether for interest rates, the 10-year Treasury, and it has stabilized over the last many weeks, and today is trading at about 4% yield. It's down over the last few days, again, because primarily of the Fitch downgrade, but let's call it 4%. The other interest rate that we watch very closely is a 2-year Treasury rate, which today is trading at 4.9%. So there's a difference between a 2-year Treasury at 4.9% and a 10-year Treasury yielding 4%. There's a 90 basis point differential. And normally we would want to see a yield curve, which is the curve that represents the different rates, yields at each of these maturities. You would expect a normal yield curve that the longer the maturity is, that the higher the interest rate, the market interest rate would be. And today we're in an inverted yield curve where that relationship is actually inverted. It's the opposite. So a shorter maturity Treasury 2-year at 4.9% is higher, 90 basis points higher than the 10-year Treasury rate, which is at 4%. And this is an inverted yield curve. We talked about it before. It's been in place for many months now. It's been quite persistent in this relationship of an inverted yield curve. And one of the big reasons that it is important is that inverted yield curves have a very good record of predicting a coming recession. And we can see this in a graph here going back to 1985, where an inverted yield curve precedes a recession. And it's such a strong relationship that many economists just can't get past the fact that with the inverted yield curve to the degree that it is today and the persistence that it is today, that it just absolutely must mean that a recession is around the corner. It's a hard argument to debunk, and it is really the fuel that drives those that say that we still have a recession ahead of us. And in fact, a recent Bloomberg survey of 75 leading economists have consistently said that there's a 60% chance of a recession. So we have this still in front of us. However, there's a lot of competing data that would argue that no, we don't have a recession immediately in front of us. In fact, we might have what's called a soft landing. And the Fed, in its work, in managing the Fed funds rate as a way to manage inflation and the job market and the overall economy, really is in a position of fine-tuning, fine-tuning interest rates in a way that portrays quite a bit of confidence in the Fed and their program and the potential outcome of their program. They paused rate increases in June. However, they did increase interest rates by 25 basis points in July, bringing the Fed funds target rate to 5.5%. But in doing so, the Fed really talked about it being fine-tuning, and that additional hikes may be possible, but they left open the opportunity of stabilization in the Fed funds target rate. They're not quite talking about a reversal, but they are beginning to talk about a stabilization and holding rates steady. So it gives us a sense that the Fed has a growing view of confidence of their program and the economy, and potentially our ability to avoid a recession and have what we hope would be a soft landing in the economy. And let's look at kind of the basis for that. So the Fed, as we've talked about so many times in the past, has two primary jobs. One is to maintain asset stability or inflation rates, and the other is to regulate the job market or the employment market. So if you look at inflation, after being up nearly 9% or at 9%, today, inflation year-over-year change in the consumer price index, you can see is down to just a growth of 3%, and a long-term target rate would be close to 2%. So the Fed really, its work is proving and bearing fruit. If you exclude food and energy, it's a year-over-year change of 4.8%. And if you look at producer prices in June of 2023, what we see is even a more dramatic improvement in the inflation numbers. And we know that producer prices are a harbinger, a leading indicator of what consumer prices will be going forward. So this is a positive indicator, again, of inflation and it coming back to more historical norms, something around 2%. And one of the things that was just recently published, we saw this in Bloomberg, is really truly a Goldilocks scenario, where in the upper data set, you see personal consumption. So what we see here is growing personal consumption or consumer demand. Consumers are spending more money, and it's been growing over the last few months, but it's not driving more inflation. In fact, we're seeing lower inflation at a time when there's more consumer spending, which really speaks to the overall strength of the economy. It's what the Fed would hope for is that the consumer still stays engaged, but they do so in a way that's not driving inflation. So it's really a very, very positive relationship that we see. The other job of the Fed is to regulate the job market, employment. And what we're seeing is a stabilization of job growth. We're not seeing a sharp cliff or decline in job growth, but a really very sustainable rate of increase in jobs added. Here, most recent data is in June. So when you look at the Fed program, their primary objectives, they really are the data is supportive of a successful program. At the end of the day, what really matters or one of the things that really matters is GDP growth. And increasingly, leading economists are expecting that GDP growth will remain positive. Again, an example of a soft landing, of an avoidance of a recession. It's not off the charts stellar job growth, but it is positive. And the sense is that things are moving in the right direction. So those economists, those traditionalists that can get past an inverted yield curve and some other kind of historical data points and look at the more current data that we're seeing, will argue that, hey, maybe we will see a soft landing. And we'll leave it at that on good news, with the hope that that is, in fact, what we'll see in the market going forward.